All right, now that we've had a chance to take a look at one particular method of valuation called the Gordon constant growth model, what the constant growth model assumes is that growth is constant. That's not always a fair estimate. What's always better is to be able to predict exact cash flows that are most likely to occur at very specific times, and then to compare those to the opportunity that you have to earn those cash flows vis-a-vis, there's some French for you, other investments that are risky. One of the ways that we can do that is what's called the dividend discount model. Again, if you want to look up more information, remind me later, on the dividend discount model, it's certainly something that you can Google and take a look at. And again, I like Corporate Finance Institute. They do a really nice job of explaining how this thing works. And there is a presentation of our formula we just did. The value of the stock is equal to the dividend over R minus G. That was the previous one. Investopedia, if you look it up, also does a nice job of oftentimes, let's see if they have one for this. They often will embed videos into theirs, just like I'm doing right now. Doesn't look like they have one for this particular. Oh, yeah, they do. Right. So they have a dividend discount model video too that you're certainly able to watch if you'd like more information about it. But I will show you the application of it. So let's say we have an analyst at Morningstar looking up a company called PAPE Inc., and that company has come out to the public and via its investor relations function has said, here is what we're telling you. 1 year from now, we plan on paying a $1 dividend. And 2 years from now, we're going to up that dividend by 50 cents to $1.50. In the third year, we're going to up it by another 75 cents to $2.25. And then finally, in that fourth year, we're predicting that we will up the dividend by another 125 to 350. So that analyst sits down and does some of the calculations like you and I are working on right now and goes, if that's the case, the consensus estimate is by the end of the fourth year, my buddies and I are talking about, we think that the PAPE stock is likely to sell for $45. So now she looks and sits and does a similar analysis like we did up here on going, what should an investor earn as a percentage growth rate of return if they were to invest in PAPE? And so her calculations tell her, let's use a 10% opportunity cost of capital. And then right now, just like we did in the previous, she looks up and sees that the price of PAPE is currently $38. Her whole job is to talk to people that are in the investment community and suggest to them whether or not buying PAPE with these expected cash flows and this rate of return with a current listing price of $38 or not, is that something that she suggests that we should buy? So down below, I've built something that you're going to see us do again when we get into our capital budgeting problem, which is a little model that helps us do dividend discount model valuation. And it works like this. The first thing it suggests is we have to use a 10% opportunity cost of capital. That's what investors expect. We are looking then at a period of analysis here that is 4 years long, where in the first year, the dividend that is expected to be received is $1. In the second year, the dividend expected to receive is $1.50. Third year, 2.25. Fourth year, $3.50. And then at the end of the fourth year, the suggestion is you could sell this stock and earn $45. So these are the expected cash flows that you would receive as an investor in this particular stock over the next 4 years. But what we in finance really concern ourselves with is what's present value. And so what we can ask ourselves is, if we were to insert the formula that's a financial formula for present value, and listen to the way that I'm going to describe this wording right here. If I could earn a 10% rate of return, but in 1 year I could expect to receive a future value of $1, how much should I be willing to pay for that today? Notice it comes up as a negative. What it suggests is that you should pay up to 91 cents for the promise of getting in one period $1 at a rate of 10%. How about for the second one then? Let's answer the question the same. If at a rate of 10% in 2 years, I could receive a future value of $1.50, how much should I be willing to pay for that today? Is $1.24. Doing it again for this third one, at a rate of 10%, when I'm now waiting 3 years, and I would eventually get $2.25, what would be the present value of that? Is $1.69. For the last one then, it's going to be the same process. We're just going to include both expected future values. So again, at a rate of 10%, we're now waiting a full 4 years. And this time, the value that we're going to get is going to be both this one and that one, because we're going to go ahead and have not just, oops, I clicked on the wrong thing, our dividend in that year, but we're also going to have our sale price. So you'd get $48.50 total, which tells you then you should be willing to pay up to $33.13. So if you were to be able to pay 91 cents to get the dollar, $1.24 you'd pay to get the $1.50, $1.69 you'd pay for the future $2.25, and $33.33 you'd pay to get that future $48.50, how much would you be willing to pay in total? Well, if I just sum these things up then, because I'm pretending like I'm in the present, I can say my total willingness to pay would be $36.97. Notice it's a negative because we use the Excel present value functions. Excel is telling us to get something back, you have to pay something now. I don't like the way that looks personally. So what I like to do is go and switch the sign by just putting a minus in front of the formula there. And then this to me makes more sense. The fair price is $36.97 as opposed to the negative $36.97. Same concept, different presentation. The market price is $38 right now. So according to you, at $36.97, this thing is overpriced. So right now, again, we could ask, should you buy it or not? If the fair price is greater than the market price, then buy. If not, do not buy. So in this case, again, what we find is using the dividend discount model, for which we predicted cash flows that would come at specific times, when we analyzed our opportunity to do something different, and then calculated our willingness on a present value basis to pay a certain amount in total that we could then compare to the market price, we can now help her at Morningstar come up with a recommendation to investors that says, do not buy. Stop.